on November 4th, 2015. The topic is Information Reporting by Large Employers, IRC Section 6056, and the focus is on lines 14 to 16 of the 1095C. My name is Lisa Klinger. I'm the benefits attorney with the Leavitt Group, and I'm hoping that everyone can see my screen just fine and that you can hear me just fine. So if you can't do either of those, please either text me on my cell phone or type in a question. You are all in listen-only mode, but you can type in a question probably on the right-hand side of your screen in the little box, and I'll try to answer questions every so often, and I will try to look at that so I can see who's texting me about anything. So let me see. Let me open that box in case I have anything from anyone. All right. I don't see any comments yet. So I'm going to cover a number of things on the information reporting today. First, I want to mention if you don't have a copy of the PowerPoint, you can request one from the Leavitt advisor who invited you, and I'm sure they would like to follow up with you, so you can request that from them. I did make some last-minute changes yesterday evening after we had already posted the PowerPoint yesterday, so I will tell you when I get to those. I think it's pages 47 to 49. I changed something and I switched the order of two of them. So if you have a version that you got before this morning, you can get the final version after the webinar if you'd like, and I'll just note what the changes are when we get to it. There are also two other handouts. One is a matrix that shows details for lines 14 to 16 for some different situations. And then there's also a handout that talks about how to code it for COBRA situations, and that's from the IRS website. The IRS did make changes in the final version of the instructions. There was a draft version and then a final version. They made changes in the final version on the COBRA reporting, and then they made changes in the Q&As that are posted on their website. So that's what I have gave a copy of. So let's get started. Let's see if this works. Page down, that's not working. Oh, there we go. So here's the agenda quickly, and I'm going to do a short overview of information reporting and the sections of the ACA that apply, and then I'll talk about the penalties. I'll talk about the forms in general, and then I'll give some examples, a number of examples focusing on lines 14 and 16, and then some special situations. I do have, there was a second half to this presentation which was on the 1094C, and I basically just broke it into two sections, so it's only the first 61 pages at this point. I thought I would try to start out with a little humor. I really like this Cat Bert cartoon. Cat Bert says, "Today I will teach you how to fill out a 1095C form for the Affordable Care Act. Just randomly check boxes and hope no one ever notices. I've been doing it for years, and it's a huge time saver." So it would be a huge time saver, except it would probably subject you to penalties afterwards. So it wouldn't be worth the time savings, because you could have penalties of $250 or even $500 per form. And I'll talk about those penalties in a bit. So here's the quick overview of the relevant ACA provisions. And the reason it matters is because the purpose of the information reporting is so that the IRS can basically enforce these provisions of the Affordable Care Act. So first is the individual mandate, and that requires that most individuals have to have minimum essential coverage, or MEC, for each month, or they have to pay a tax. And then the employer mandate requires that applicable large employers, or ALEs, have to offer minimum essential coverage or minimum value and affordable coverage to substantially all full-time employees, or they may be subject to a penalty if any full-time employee goes to the exchange or marketplace and qualifies for a subsidy. And moving over to the bottom left of our circle, the health insurance marketplace is a place, an online portal basically, where individuals and small employers can buy health insurance. And they can shop for insurance and choose what they want. And then the subsidies on the bottom right, basically lower income individuals might qualify for certain subsidies if they buy health insurance in the exchange. And if they have to meet certain income guidelines and residence or citizenship guidelines, and then also they have to not have affordable minimum value coverage available through employment. And the subsidies can be premium tax credits or cost sharing reductions. So those are the relevant provisions of the Affordable Care Act that the information reporting applies to. Now I've included this helpful page of ACA acronyms and terms. And I won't go through these all right now, but I'll be using these terms in the presentation and also trying to explain what they are. But you also might want to have this to refer back to later. And I put them in alphabetical order. So let's get started. First of all, what is information reporting? Well, it's basically the forms 1094 and 1095, and it's not a tax that's paid. It's information that has to be provided on certain IRS tax forms, and it's health plans and large employers and insurers have to report and furnish information. So they're reporting certain health coverage information to the IRS. And then the second part of the requirement is that they have to furnish the annual statements to individuals, either individuals who are, for employers, who are full-time employees, whether or not they have coverage, and also for the plans or carriers, they have to furnish it to individuals who have coverage. And there's an A and a B and a C series of the forms. So the C series is what large employers have to file, a 1094C and the 1095Cs, and that's under Internal Revenue Code Section 6056. The B series is what self-insured health plans file, so even small employers with self-insured plans, and also insurers and HMOs file this, and they're called MEC providers, or minimum essential coverage providers. So they're not medical providers like doctors, but they're the entities that provide the health coverage, and that's under Section 6055. And then the A series form is what the exchanges or the marketplace files. So again, as I said, why do we have information reporting? Well, it's so the IRS can determine what penalties might apply to employers and what taxes might apply under the individual mandate to individuals, and also what individuals are eligible for the subsidies and which individuals are not eligible. And the reporting forms provide this information. So for example, the reporting form will tell whether an employer offered MEC to substantially all their employees, and whether the coverage that was offered was affordable and provided minimum value. And it will also tell whether individuals have minimum essential coverage. If they have minimum essential coverage, they're not subject to the individual mandate tax. And the forms also tell whether the coverage was affordable or met minimum value. And if it was, and it was offered to people, then those individuals are not eligible for a subsidy. And then the other reason that you need to do the information reporting is that there are penalties for not reporting. And I'll go over those in a later slide. Let me give you a quick overview of the employer mandate requirements, and those are under 4980H. And those are different from the information reporting requirements, but again, the purpose of information reporting is partly to determine what employer might be subject to a penalty under the employer mandate. So there are two different penalty sections under the employer mandate, and that's 4980HA and 4980HB. And A is the section that says it's the sledgehammer penalty. So if an employer doesn't provide minimum essential coverage to at least 95% of its full-time employees, and only 70% for 2015, and that applies for employees and their dependent children, and if at least one full-time employee enrolls in the exchange or marketplace and qualifies for a subsidy, then the employer will be assessed a penalty. And this is the penalty that was originally $2,000. It's up to $2,080 for 2015, and for 2016, it's up to $2,160. But if you have to calculate the penalty, you get a pass for the first 30 full-time employees. And one of the special rules for 2015 is that you get a pass for the first 80 employees if you had at least 100 full-time employees in 2015. And just a note that full-time employees, as I'm sure everyone knows by now, for this purpose, full-time employees are employees who average at least 30 hours of service a week or 130 hours per month. And keep this in mind for later. If the coverage is not offered for any day of a calendar month, even if it's offered for 29 days, but not the 30th or the 31st day, or if it's offered for 18 days, it's treated as if no coverage was offered for the entire month. So keep that in mind for later when we're going through some examples on the forms. Now, secondly, the 4980HB penalty is often called the tack hammer penalty. And that applies if an employer does offer minimum essential coverage to at least 95% of full-time employees and children, or 70% in 2015, but the value of the coverage either doesn't meet minimum value or it's not affordable. And in that situation, that means the individual will qualify for a tax credit. And so that means the employer could be subject to a penalty. And that penalty is the one that was originally $3,000 per year per employee, and then it's $3,121 for 2015, and it's up to $3,240 for 2016. But that only applies for each employee who wasn't offered affordable or minimum value coverage and who went to the exchange and got a credit. So, and also that penalty will be the lesser of the A or the B penalty. So the B penalty can't be more than the A penalty would have been. So, moving along with the overview. Who has to report information to the IRS? Let me see if I can take a little bit of a digression and see if there are any questions. Why am I not? There we go. See if I can check if there are questions. And I don't see any questions yet, so that's good. Okay. So who reports? Well, large employers have to report, and that's large employers who have at least 50 full-time equivalents. So it's not just 100, but for reporting purposes, it's 50 or more full-time equivalents. And that includes all types of employers, so for-profit, not-for-profit, government employers, church employers who have full-time employees. And it also includes certain small employers who have under 50 full-time employees or equivalents. So the two categories there would be if you're a small employer but you sponsor a self-insured plan, then you still have to file the 1094B series and the 1095Bs, furnish those. And for example, a level payment plan would be a self-insured plan. Also, if you're a small employer but you're part of a control group or affiliated service group that has 50 or more employees, full-time employees or full-time equivalents, then you also have to file. Also, carriers have to file, and as I pointed out earlier, the marketplace has to file, and certain individuals have to file. And here's a little graphic we did a while ago that hopefully makes things a little clearer. Here's the IRS, here's the individual. So, for example, the individual is filing the 1040 and also filing an 8962 or an 8965. The 65 is if they're claiming exemption from the individual mandate, And the 8962 applies if the individual received a premium tax credit in the exchange. And then they're also filing the 1040 and the information from the 1095 A, B, or C. But the individual is getting information, is getting 1095s, maybe from the marketplace, from the MEC provider, and also from the employer or former employer, the large employer. And then these entities are also filing the 1094s with the IRS. The filing with the IRS is actually a 1094 plus copies of all the 1095s. So that's the information filing that gets filed. And I'm sure everybody knows this stuff by now. A little bit more on who reports to the IRS. Obviously, employers, large employers with at least 100 full-time employees or full-time equivalents report. But also, employers with 50 to 99 employees who qualify for the one-year delay of the employer mandate. So even if you weren't subject to the mandate this year, but if you have 50 to 99 employees, you still need to do the information reporting for all of 2015. Also, employers with 100 or more employees who had non-calendar year plans, for example, if your plan started April 1st and you qualified for the delayed effective date of the employer mandate, you still have to do the information reporting for the entire calendar year of 2015, starting January 1st. And thirdly, if an employer has 100 or more full-time employees, or even 50 or more, even if the employer doesn't offer coverage, the employer still has to do the information reporting. So it's not just a report of coverage, it's also a report of non-coverage. The next issue, when is the information reporting due? Well, it applies for the 2015 calendar year. Originally, it was going to be effective in 2014, but there's a one-year delay. And so the data is for the 2015 calendar year, but the first reports and the annual statements to individuals are due in the first quarter of 2016. So by February 1st, 2016, the reporting entity has to furnish the annual statements to individuals, the 1095 A, B, or C. And it would be January 31st, but that's a Sunday. Then by February 29th, 2016, you have to file the information reports with the IRS if you're filing paper reports. If you're filing electronically, then the reports are due to the IRS by March 31st. You can get an automatic 30-day extension, and in order to do that, you need to submit Form 8809 to the IRS on or before the due date of the filing, so like by February 29th or March 31st. And you don't have to sign it or have an explanation, it's just an automatic extension. I'm going to talk a little bit more about electronic filing in just a minute, but I wanted to do one slide on the different reporting methods while I'm talking about reporting generally. So the regular method is the general reporting or full reporting, and then there are 3 alternative methods. And the qualifying offer method is if the employer offers minimum value and affordable coverage to an employee and offers at least minimum essential coverage to the employee's dependents and spouse, so not just dependents. And the affordability, the coverage has to be affordable under the federal poverty level safe harbor. So there are the different safe harbors, the federal poverty level, the rate of pay, and the W-2 method. So under the qualifying offer method of reporting, it has to be affordable, the coverage has to be affordable under the federal poverty level safe harbor. Second, there's a 2015 special transitional method. And under that, the employer has to make a qualifying offer, as I just defined, to at least 95% of full-time employees. And then the third one is the 98% offer method, which, as you can guess, means the employer has to make an affordable minimum value offer to at least 98% of employees on whom it would be reporting, but it doesn't have to be using the federal poverty level safe harbor. You can use any safe harbor you want for affordability. And as I'm sure everyone knows by now, the federal poverty level safe harbor is the lowest one, about $93, And the two other methods, the rate of pay and the W-2, will yield higher maximum amounts that the employees can be charged. So why would an employer want to use an alternative method? Well, basically it's because some of them, at least in theory, require the employer to collect less data because you don't have to populate certain lines on the forms. So it should take less time to complete the form. However, the reality is you might be collecting all that data anyway, especially the first year, and because your system is collecting all the data. So at least in theory, it would save you time and work. And secondly, how do you determine which reporting method you want to use? Well, you might use more than one reporting method in any particular year. You might have one reporting method for one group of employees and another for another group. You do have to use the general method unless you qualify for an alternative method. But just because you qualify for an alternative method doesn't mean you have to use it. You could still use the general method. So a little bit about electronic filing and electronic state disclosure. So the filing is the filing with the IRS. And a reporting entity is required to file electronically if they're going to be filing at least 250 returns. And each 1095-C is a separate return, plus the 1094-C is a return. If you would be required to file electronically, you can get a waiver from the electronic filing requirement for this year. And in order to do that, you have to submit the Form 8508 to the IRS, and you have to submit it at least 45 days before the filing due date. So that means by February 15th, if you're required to file March 31st. So keep that in mind in case you run into some snags or glitches later and you decide that maybe you're going to file paper instead of electronically. And if you're using an outside service provider and they're filing on your behalf, then it's fine. You want them to file electronically. But if you end up doing it yourself, some of the issues with filing electronically are that you have to use the AIR program, the Affordable Care Act Information Reporting Program for electronic filing, and you have to use the AATS, which is the ACA Assurance Testing System. You have to test transmissions beforehand to make sure that it will be reportable, that it's working correctly. You also have to apply for a Transmitter Control Code, or TCC. So if you're not hiring a third-party vendor and you're doing it yourself, definitely look at IRS publications 5164 and 5165. And the IRS does note that if you have fewer than 250 returns, you can choose to file electronically rather than in paper, but I'm guessing you won't want to do that unless you've got a third-party entity doing that for you. And if you file on paper, you send it to the IRS by first-class mail. Now, the other thing is electronic disclosure, which is when you're furnishing the forms to individuals. So in order to give your employees the 1095-C electronically, they have to first, beforehand, they have to affirmatively consent in a manner that demonstrates that they're able to access the electronic statement. So, and they can later withdraw their consent, and if you change the hardware or software that's required to access it, then you also have to get a new electronic consent. But it may save you a lot of money to have the forms just electronically available. So if you're going that route, you may want to send an email to your employees, like now, and ask who will consent to receiving the 1095-C electronically. And IRS publication 5223 has instructions on what you need to do to get the electronic consent. A couple other things on the electronic filing. You definitely need to talk with your payroll vendor or hire a third party that specializes in information reporting and that will submit it for you and make sure that they're going to be responsible under the AIR program and the AATS and get the transmitter control code. So you don't have to do that, because the other thing is that some vendors are populating the forms for you if you put in the right information, but then you need to do the filing. So if you're going to have more than 250 forms, if you need to end up doing the filing, you need to do it electronically, and then you'll also have to do get the TCC and test the transmissions. And just to let you know, many of the payroll and other vendors have a deadline that's either already passed or that's very quickly coming up. Like some of them have a November 15th deadline. There are also some other third parties that have later deadlines, and that will basically work with you and pull data from different sources, like it's an ACA tracking system, rather than being a separate payroll, HR, ACA system. So they'll pull data from your different databases. But that's definitely something you need to look into if you haven't, if you don't already have a third party. So I can't stress enough that you might want to hire a TPA to do it for you, because they'll have to pull from different services, and you also want a TPA where they have reporting capability during the year, so you can monitor how things are going. If you do your own payroll, then you need to definitely, your programmer should already be involved. And if you're working on having an Excel spreadsheet, hopefully you're very far along in that process. So let me talk a little bit about penalties. And these are penalties for the information reporting. So I'm not really talking about what I mentioned earlier, the employer mandate penalties, the 4980H, A, and B. What I'm really talking about here are the penalties for late filing or non-filing for the 1094 and 1095Cs, and also potential penalties for inaccurate filings. So let me see. The regular penalties, it's under Tax Code Section 6721 and 6722, are $250 for each return or statement, whether you're filing it or furnishing it. Excuse me, that can be reduced to as low as $50 if you can show the failure was corrected quickly. However, if the IRS feels that you intentionally disregarded the filing requirement, then the penalty can be $500 per return rather than $250. So if you had 100 returns and the penalty is $25 or $250, that's $25,000. If it goes up to 500, that's $50,000 just for not filing. And these penalties apply not just for the 1094 and 1095 filings, and this applies for all types of filings. So, and let me go up a page and then back. Under the Trade Preferences Act, which was just enacted earlier this year, the penalties basically increased. That was just passed on June 29th. The penalties basically doubled for failure to file the returns, and and these are the annual caps on returns. So let me go back a page. However, there is transition relief for inaccurate or incomplete filings. And this applies only for 2015, for the 2015 year, for the filings due in 2016. And the relief is if the employer or filer made good faith efforts to comply, then no penalty will apply for inaccurate or incomplete filing. If you file late, the late filing penalties still apply. But the penalties do apply if you didn't make good faith efforts to comply. So let me just talk about that in terms of the requirement that you request Social Security numbers. 6056, the large employer reporting requirement, requires you to report full-time employees' Social Security numbers, and you probably have those in your records. No doubt you do. But 6055 also requires that reporting entities report the Social Security numbers of all covered individuals. So that would include all family members who are enrolled. So it's not family members who are not enrolled, it's just family members who are enrolled. So if you're a self-funded plan, then on the 1095C in Section 3, you need to report the information on all family members who are enrolled. And you'll see that in a few more slides when we get to it. There are particular rules in the IRS guidance about what's a reasonable effort to obtain the Social Security numbers. If you can't obtain the Social Security numbers after you make a reasonable effort, then you can use the date of birth. But the guidance on what constitutes a reasonable effort. So right now it is when the individual first enrolls, you need to make an initial request for the Social Security number, and that can be in writing or verbally, but you probably want to do it in writing. Or if they were already enrolled as of September 17th, 2015, the date of the guidance, then you have to make a request at the next open enrollment period. So that's probably, if you have a January 1 plan year or a December 1 plan year, that's probably about now. Then you also have to make a second request a reasonable time thereafter. Not sure what that would be. Maybe it's January of 2016 or the end of the first quarter. And then you have to make a third request by December 31st of the year following the initial request. So in order to be considered to have made reasonable effort to obtain the Social Security number, you have to follow those steps. And then if you haven't been able to obtain it, you can use the date of birth on the 1095C in Part 3 rather than the Social Security number. And let me just mention here, changing the subject a bit, on the limited non-assessment period. During the limited non-assessment period, the 4980H penalties do not apply. So now I'm going back to those other penalties, but the reason I mention it here is because this information gets reported on the 1094 and 1095C. So the limited non-assessment period is for a limited or a short specified period of time. The assessment is the penalty, so non-assessment means no penalty. So if a particular employee is in their LNP, or limited non-assessment period, then, and if you don't offer coverage to them while they're in their LNP, then you won't be subject to a penalty for that period of time. And the limited non-assessment periods, for example, include the waiting period, up to 90 days, or the initial measurement and administrative period for new employees if you're using a look-back measurement method, or the look-back period if you're using it for ongoing employees, if you're using the look-back measurement method and the person isn't already covered, eligible for coverage. Also, if someone is hired during the calendar month, not the first day of the month, then the rest of that month is also considered their limited non-assessment period. So now I'm going to look at the forms in general, the 1094C and the 1095C, and then I'll go through some specific examples on the 1095. But before I do that, let me see if I have any questions. Looks like I do have some. If an employer is offering minimum essential coverage and affordable coverage to every eligible employee, would there be a downside to using the 98% method? I don't think there would. I think if you're using if it's affordable minimum value coverage, I think you probably would want to use the 98% method. So I can't think of a downside. Let me see if I can get. Can't I get this to be larger? Sorry, I'm trying to make the question more readable. can't read the beginning of it. Something if the does something apply to the orientation period? If the employer is offering MEC and okay. How does the LNP apply to the orientation period? If the employer has a bona fide orientation period, the law does allow you to not just have the waiting, the LNP would include a bona fide orientation period. So the law allows an employer to add a 30-day bona fide orientation period and then start the 90-day waiting period after that time. So if you had a bona fide orientation period and then a waiting period, that basically would extend your LNP by 30 days or up to 30 days. Is the 30 hours a week or 130 a month an average? Let's see, how can I answer that? The definition of full-time employees were applied for two different purposes, for determining the employer size and for determining which employee is full-time, has full-time status. So I guess the shorthand answer is the average part is 30 hours a week, but if they work 130 hours in a month, that's kind of the number that isn't just an average. However, if you're using a look-back measurement method and you set your measurement period at 6 months, then if the employee works 780 hours in the 6-month period, the employee is considered full-time for that period, for that measurement period, and then that means they're full-time for the stability period. And if you use a 12 months, then it's 1,560 hours rather than 780. So in that sense, it's say 780 divided by 6 is 130 hours a month. So in that sense, it's an average, but if the person worked 45 or 60 hours a week for a number of the weeks, they could end up working 0 hours at the end. So it's really for that purpose, it's how many hours they work in the measurement period. Let me see. What happens for the employers as far as any penalties where employees who waive coverage if they qualify for Washington Apple Care, I think that's probably Medicaid, or free health care through the state? The employer doesn't have a penalty. The employer's obligation is to offer coverage. It doesn't matter whether the person enrolls or not. So if the employer offers coverage, then, and it's affordable or minimum value, then they're not subject to the penalty. So the other answer to your question is, the other part of that answer is, the employer is only subject to a penalty if at least one full-time employee goes to the exchange or marketplace and qualifies for a subsidy. So if you didn't offer coverage, where you offered coverage that wasn't affordable, and nobody went to the exchange and qualified for a subsidy, you would not have a penalty. But if a number of employees went to the exchange, but they qualified for Medicaid, so they didn't get a subsidy, then you still wouldn't have a penalty. And so employers may not want to take that chance for purposes of the excuse me, of the sledgehammer penalty, the 4980HA penalty. They may be more willing to take that chance for purposes of the B penalty, feeling that some employees will go and they'll get not a subsidy but Medicaid instead. However, you may not want to take that chance because you really don't know what people's family or household income is. All right, so let me get back to the forms in general and the examples. This is what the first page of the 1094-C looks like, and that's the transmittal form that the employer submits to the IRS. So in the first section, Part 1, it's information about the applicable large employer, and then information in line 18, the total number of 1095-C forms that are submitted, and is this the authoritative transmittal for the ALE member? And then Part 2 is the ALE member information, the total number of forms. Are you part of an aggregated group? If you are, you need to include the information on page 3. And then there are certain certifications under line 22. If you're using the qualifying offer method or the transition relief method or the 98% offers method, or if certain transition relief applies. If you have 50 to 99 employees, or if you had 100, but you're subject to the offset of 80 rather than 30 this year. The other thing I'll just note, if you are in a control group, on the third page in Part 4, you have to list the name and EIN of the 30 largest employers in the control group, and you have to list them by order of largest to smallest based on number of employees. So that's kind of a pain. On the issue of the authoritative transmittal, any 1095-C that you file with the IRS has to be attached to a 1094-C. And an applicable large employer member, if you're a member of an ALE, you can submit multiple forms 1094-C, but there has to be one authoritative transmittal that has the aggregate level data for all full-time employees of all employers in the aggregated group. So but that's not in the aggregated group, in the employer. So if you're in a control group, each employer has to submit their own authoritative transmittal. And if you're in a control group for any month of the calendar year, you check the box listing which month you're in a control group. Now this is the 1095-C. This is what goes to the employee. So you've got the employee information here, the large employer information there, and then the lines 14, 15, and 16, which are showing either for each month separately, or if it was the same for all 12 months, you can just use the one column. There are certain indicator codes, and I'll show you those for the different offer of coverage for what was offered, what was the employee share of the cost for the lowest cost employee-only coverage that was available to that employee, and then the Series 2 code, which indicates if certain safe harbors applied, or if the employee enrolled, or leave it blank if they didn't enroll. And then Part 3 is if the employer is self-insured. Then you need to provide information in Part 3 about each individual who was enrolled, and this is where you'll have the Social Security number or the date of birth. So that's the, and I just want to reiterate, for applicable large employers, if you have to give, the reporting requirements apply separately for each ALE, and you have to give a 1095-C to each employee who is a full-time employee for at least 1 month, even if the employee was not offered coverage. If you're just an applicable large employer and you're not a member of a control group, then the ALE member is the ALE. But if you're in a control group, you each have to furnish your own 1095-Cs to your employees and submit your own 1094-C. The contrast is, if you have one applicable large employer but different divisions or different business lines, then only one 1094-C is authoritative. 1094-C is filed, and all employees of the different business units have to receive the 1095-Cs from the same employer. They can't get different ones from different members of the control group. So let's go through some examples. Basically, the line 14 asks about the offer of coverage. And if the employee was a full-time employee for at least 1 month, you have to enter a code for each month. even if they weren't a full-time employee for all of the months. And I have an example that shows that. And an offer of coverage means it has to be offered for every day of the calendar month. So if it's not offered for every day, then it's treated as not offered for the entire month. And you have to have an open enrollment, or at least give people an annual opportunity to decline coverage. And these are the Series 1 indicator codes for line 14. Now, if you're using an outside or a payroll service or any kind of outside or software, it's probably defaulting a lot of these. It's putting in the information based on the information that you've input, like the qualifying offer or no offer of coverage. But you still may want to know what the codes are. So 1A, I think, will be used a lot, the qualifying offer. Also, one of the other codes, B, C, D, or E, if you're offering coverage but it's not a qualifying offer. So if you're using the rate of pay safe harbor, for example, not the federal poverty level safe harbor, but you're offering it to, you might be using code 1E a lot, is my point. If you're offering coverage that provides at least minimum value to the employee and dependents and spouse, but you're using the rate of pay safe harbor, not the federal poverty line, then you probably use the 1E code. 1H is no offer of coverage. You didn't offer health coverage or offered coverage that's not even minimum essential coverage. So line 15 is where you're going to put in the amount, the employee cost for self-only coverage. And this line is used by the IRS in determining whether the individual was eligible for subsidies. So and you leave line 15 blank if line 14 was 1A, 1F, 1G, 1H, or 1I. So just to go back to that, if it's 1A, it's a qualifying offer. So that's already saying it was the federal poverty level or less, so it met the 9.5%. So you don't need to put it in, you don't need to put a dollar amount in line 15. And if it's 1F, that you were there, it was not offered, so you don't need to put it in. What did I say were the other ones? Okay. F, G, H, and I. So G, it was if the person enrolled was not full-time, but they enrolled anyway, no offer of coverage, you don't have to put in an amount, obviously. Or if it was the qualifying offer transition relief, then you don't have to put in the amount. But if it's the other codes, B, C, D, or E, then you do need to put in the amount. And I'll show you an example on that. And it is the employee cost for employee-only coverage for the lowest cost monthly premium that's offered to the employee. So even if the employee opts for more expensive coverage, you're putting in the lowest cost that would have applied. Line 16, this is assessing whether the employer complied with the employer shared responsibility. So, and if more than one code applies for the same month, usually the default is code 2C, even if something else would apply. And this is the Series 2 indicator codes for line 16. The ones I think you're most likely to use, well, probably most likely is 2C, employee enrolled in the coverage offered. If the employee enrolled, the employer is not subject to a penalty, even if the cost was more than 9.5%. Also 2A, employee not employed on during any day of the applicable month. Or 2D, the employee was in their limited non-assessment period that I talked about a few slides ago. So here's an example. Example 1, the employee received a qualifying offer and enrolls for all months of the year. So line 14 is 1A, the employee, hardworking Sally, enrolled, received a qualifying offer. Since it's 1A, you don't have to put anything in line 15. And then line 16 is 2C, the employee enrolled in the coverage offered. Example 2 is non-covered Nellie. So non-covered Nellie is a full-time employee all year, but is not offered health coverage and is not in the look-back measurement period. So 1H is the employee was not offered coverage, and so there's no reason to put anything in line 15. Line 16 is 2D, employee in limited non-assessment period for January, February, March, and then the rest of the month you just leave it blank because the employee, there's no code that explains why the employer might not be subject to a penalty. It's just that they didn't offer the coverage to that person. Example 3 is if the employee, I'm calling her Olivia Options, received an offer of minimum value for herself and her dependents from January to December. So I'm just using it, so I get another code up here. It's 1C. And she was offered 2 plans, one that cost $90 a month and one that cost $101 a month for self-only coverage. And she enrolled in the higher cost plan, the one that cost $101. But line 15 is $90 because what you're putting in is the lowest cost coverage that was offered to her. And then line 16 is 2C, showing that she did enroll in the coverage that was offered. Example 4 is part year Paul. So here's where it gets a little more complicated. So Paul is hired in May 1st, to work full-time, and he's in a waiting period in May and June. He's got a 2-month waiting period. And then in July to December, he's offered minimum value coverage, and his spouse and dependents are also offered that coverage. But it's not a qualifying offer, so it's not using the federal poverty level. Maybe it's the rate of pay safe harbor. So when he's not an employee, January to April, line 14 is 1H, no coverage offered, and line 16 is 2A, that he's not an employee. Then May and June, when he is hired, it's still 1H, no coverage offered, but line 16 is 2D because he's in his limited non-assessment period. July through December, the code is 1E because he was offered coverage for himself and family, and it's minimum value, but it's using the rate of pay safe harbor. So in line 15, you need to put in what the employee cost for self-only coverage is. And then line 16, it's 2C because employee enrolled in the coverage offered. So there'd be no penalty for the employer. Now let me just point something out here that a number of people had said before, oh, I'll just wait and see if I get audited. They can't audit everybody. But the reality is the IRS doesn't have to come audit everybody because the information that you're putting in these 14, 15, and 16 is really what's letting the employer or the IRS know whether you're subject to a penalty. So since the person is enrolled, there's no penalty. But if it's not enrolled, if you offered coverage and say this cost was $200 and the person's not enrolled, then it's because it wasn't meeting one of the safe harbors, the affordability safe harbors. Now, here's example 5, variable hour Violet. So Violet is hired and works as a variable hour employee all year. So the employer doesn't offer coverage, so it's 1H, and they don't have to put anything in line 15. And then in line 16, you could put 2D, that she was in her limited non-assessment period. However, the IRS instructions say that the employer is not required to file a form, 1095-C for Violet, or to give it to Violet. However, I think some employers are still going to be giving out this form or maybe filing it just so they can show that the person was in their limited non-assessment period. Here's example 6. The employee received an offer all year long, but it was less than a qualifying offer. So in this case, for example, it's going to be 1C in line 14. Line 15 is going to show what the amount was, and line 16 shows 2C, the employee was enrolled. So maybe in this case, it's the employer's using the rate of pay safe harbor, and the employee enrolled in it. Example 7, what if the employee terminates mid-month, but the active coverage continues through the rest of the month? So, and here's where we start getting some, it starts here in these last few. The employee is offered coverage, a qualifying offer, January through April, but terminates employment April 15th, but is offered coverage to the end of the month. I've put in 1A even in April because they're offered, they still have the qualifying offer through the end of the month. And so for January, February, March, the person, it would be 2C, they were enrolled in coverage. It's not entirely clear in this case from the IRS instructions or the IRS website, even with the new questions, whether it would, what line 16 would be for April, because it looks like it would be 2C if the employee enrolled in coverage, but it's also going to depend on what happens with the COBRA, and 2B if they're not a full-time employee and did not enroll. But it's going to depend on what the employee does. The thing that the IRS does address is, what if the employee terminates mid-month and the active coverage ends on the date that employment terminates? So the same situation, the employee terminates April 15th, and COBRA is offered. Coverage ends April 15th, and COBRA is offered. So January, February, March, the offer of coverage is 1A, but then in April it's going to be 1E. And January, February, March, line 15 would be left blank because it's a qualifying offer. But in April, when COBRA is offered and the coverage ends mid-month, then you're going to put in the COBRA cost of employee-only coverage. So that's going to be, I'm using the example, it's $400. In line C, in line 16, if the employee enrolls, it's 2C. But if the employee doesn't enroll, it'll be blank, or it might be 2B. So it's going to depend on what the employee does. So, and these are the slides that I changed from the what I had posted yesterday to show how this changes depending on whether the employee elects COBRA or not. So, and if the employee does not elect COBRA, then in April, again, the employee terminates employment April 15th, the regular active coverage terminates, but COBRA is offered and the cost increases to $400 a month for employee-only coverage. So for April, line 14 is 1H, coverage not offered, and 15 is still blank because 14 is 1H. Line 16 is now 2B, and because in the month that the employee terminates, the IRS instructions say you use 2B. If the coverage would have continued through the rest of the month, but it didn't continue because the employee terminated mid-month. But for the rest of the year, you would use 2A, which indicates that the person was no longer an employee. So even though coverage isn't offered under 1H, when the person is no longer an employee for the rest of these months, and this would be filled in for the rest of these months, then there would be no penalty for the employer. Now, another example, if the same facts initially, the employee terminates and the COBRA coverage would cost $400 a month, and the employee elects the COBRA, and it's unsubsidized. So now this goes to, for this, instead of being 1H, this is 1E. Line 14 is 1E for the rest of the year. You need to put in the COBRA amount of employee-only coverage at $400, and then 2C is going to indicate that the employee enrolled. One question that's come up is, what if the employee enrolled for a couple months and then, say in July, stopped paying and went to the marketplace? I think what should happen, and the IRS doesn't address this, is that the employee should not qualify for a subsidy because they lost coverage due to non-payment. And so that wouldn't give them a special enrollment event mid-year. But it remains to be seen what actually happens in that situation. Example 11 and 12 address what happens if an employee doesn't terminate but goes from full-time to part-time. And would qualify for COBRA. And this is treated differently than if the employee terminates. So I've got employee Patty part-time, was full-time, and had a qualifying offer January, February, March, and accepted the offer, but then changed to part-time as of April 1st. So if the employer offers COBRA for $400 a month and offers it to the employee and spouse and children, and they enroll, then that becomes 1E for line 14, and 2C on line, and in line 15 you have to put in the employee cost of COBRA, and line 16 is 2C, that the employee enrolled in coverage. However, if the employee later didn't disenroll, if the employee is full-time because she's in her stability period, if the employer used the look-back measurement method and the employee had been full-time in the measurement period, then the employee is still considered full-time in the stability period. So the employee would still be full-time, and these line 16 here would be blank, which would indicate that the employer would be subject to a penalty if the employee got a subsidy. However, if the employer used the monthly measurement method, so the employee is now part-time, then this would be 2B, indicating the employee is part-time and the employer should not be subject to a penalty. Example 12 shows what happens if the employee goes from full-time to part-time, elects COBRA, but the COBRA rate is subsidized. So, for example, maybe it's the rate of pay. The person had been under the rate of pay safe harbor at $120 a month, and then if the employee enrolls in April and May and drops COBRA in June, this shows that the person 2C is still enrolled. In June, I think it would be 2H, showing that even though the employee is no longer enrolled, the affordability of safe harbor, the rate of pay affordability safe harbor is met. Yes, so even if the employee is full-time, it wouldn't be left blank, because if COBRA is subsidized and it's $120, that would be 2H, and that would protect the employer against a penalty. On the other hand, if the employee had been covered under the monthly measurement period and went to part-time, then the code would be 2B, showing that the employee is part-time. I think I have two more examples. Example 13 is if employee is full-time for only 1 month and then is part-time the rest of the year. So my example, the person's hired in January to be full-time. In January, they're not offered coverage, so it's line 14 is 1H, and then line 16 is 2D because they're in their limited non-assessment period. Let's say the employer offers coverage the first of the next month and is offered coverage in February. It costs $120. The employee enrolls, and then the employee decides decides to be part-time instead of full-time, so loses coverage. So now line 14 is going to be 1H for the rest of the year, and line 16 is going to be 2B, showing that the employee is part-time and not enrolled. And that 2B in line 16 would also protect an employer from having a penalty those months. And the last example is the transition relief. So if it's an employer with 50 to 99 employees who doesn't offer coverage in 2015, so has a delayed effective date until 2016 for the employer mandate, that employer still has to file the 1095Cs and 1094, but line 14 is 1I, transition relief applies, and so you can just leave the rest of it blank, and the employer should not be subject to penalties. And here's just the 1095C again, so you can see that. And part 3, again, is where if you're self-insured, you need to put in information down here. So again, I just remind you, if you're self-insured, you do have an obligation to request Social Security numbers. And here's an example of what the 1094C would look like if we've got variable hour Vinny and Vinny's spouse and Vinny Jr. and another kid, and they're showing the Social Security numbers of the employee and spouse, but maybe they don't have Social Security numbers of the kids, but they did request them. So they're just, they're just putting in, the employer just puts in the date of birth for the two children. And then the employer would just show what month the person was offered coverage or enrolled in coverage. And let's see, the handout I gave you lists some other circumstances perhaps where if there's on part 3 of the 1095C, where you could complete it if you had other people who are not employees who had coverage during the year, like a non-employee director or someone on COBRA who hasn't been an employee the entire year, terminated employment in the prior year but is on COBRA all year. So, action steps for employers now. Again, I really can't stress enough, talk with your payroll provider or software provider if you haven't already been talking with them, and if you're not already, haven't already uploaded your information, hopefully you're all fairly far along on that. You might need to input additional information or get data from other databases if you have a HRIS system or HR benefits information separate from your payroll system. The other thing is sometimes you need to upgrade to additional modules from your payroll provider, and be sure when you're talking with an outside provider, get the details on whether the provider will file electronically for you or whether they'll just populate the forms and provide them to you to file electronically. Because if they're just providing them to you, and if you need to file electronically, then you need to do the things for the AATS, the testing system. You need to get the transmitter control code, and you'll have to file under the AIRS program. So you probably don't want to have to do all that. Third is think about the ramifications of the different reporting methods, which you want to use and why. And last, maybe you're already on a particular course for 2015, but think about in this season, do you want to change some things for 2016? So what did you learn so far from 2015? Because you'll want to make changes, or you may want to make changes in data gathering and what you're doing starting as of January 1st, 2016. And then last but not least, stay updated with healthreformupdates.com, which is also news.leavitt.com/healthcare reform. We always post new things on new articles on that. And here's a slide that's got government websites with information. The IRS website has this first one. They've really put together an information reporting web page, so it includes links to the forms and instructions and to a lot of different things. So that should be really useful. And then last is thank you, and I'll see if there are any other questions. If you do have questions and you don't have time to stay and listen to the answers, or you think of questions later, then you can give me a call or call your Leavitt advisor. Again, let's see, I don't see any additional questions, so that's good. Oh, here's some more questions. If you want a copy of the handout and you don't have that, check with your Leavitt advisor who invited you. I know they'll want to follow up with you, and they can give you copies of the final version. Let me see. What makes you an aggregated group? There are some different rules for government employers versus others, or for if you're an aggregated group, you might be a control group in the private sector, and then or an affiliated service group. So the control group could be 80% ownership, or it could be a brother-sister control group where there are 50 and 80% ownership rules. I guess I'd say if you have a particular question, give me a call. Let's talk afterwards. How do you report for collective bargaining groups of employees that the employer does not offer coverage or control the enrollment, but they are on the company payroll and pay their union for health and welfare? Good question. I actually took out that example that I had. I didn't know we would have any union situations. So for that, you would report, let me see if I can do that, oops, is that on here? I think this is going to be on line 14, you would report 1H, that you're not offering coverage. And then on line 16, you would report 2E, multi-employer interim rule relief. So this is for union plans. And you'd use code 1H on line 14 for a union plan, and then 2E on line 16. And the union plan would report for the individuals who are in the plan, and they're supposed to report separately for each employer in the plan. Let me see. When we hire an employee, we offer coverage the first of the month after 60 days of employment. Does that mean we have to indicate that we offered them coverage, let's say in June when they were hired but weren't enrolled till August? So the month of June and July would have a code that they were offered. Let me see if I understand that. If I'm understanding it, if you offer coverage, if you don't offer coverage until the first 2 months that they're there, they're not offered coverage, that would be their limited non-assessment period, or LNP. So for those 2 months, say June and July in your example, line 16 would be 2D, indicating that the employee was in their limited non-assessment period, and line 14 would be 1H, no coverage offered. Let's see, what is the code for line 16 if the employer had a qualifying event yet the employee declined coverage? So I think I got to that one, that let's assume that the coverage ended mid-month for the employee. They had the event mid-month, the qualifying event, and if they lost coverage, and I'm not sure if this question was asked before I got to that slide. If the employee terminates mid-month, had the qualifying event, and lost coverage, and does elect COBRA, let me see. Let me make sure I've got your question right. Let's see. How to qualify offer? Oh, yet the employee declined COBRA. So if they don't elect COBRA, then in the months that they had the qualifying event, if it's mid-month and they lost coverage, this was my example number 9. In that month, say it's the April 15th question, they, oops, where's example 9? Here we go. They lost coverage at, say, April 15th. So in April, it's going to be 1H, no offer of coverage, because it wasn't offered every day of the month. And then you're going to use 2B in the month that the person had the qualifying event, per the IRS instructions. And then if they don't enroll, you'll use 2A for the rest of the months, indicating that the person is no longer an employee, that they're not an employee for those months. So the rest of these months would be 2A, and line 14 would be 1H. And let me see, that might have been the last question. Let's see if we have any others. Okay. What if an employee is offered coverage and waives coverage because they have a valid coverage through another? then you would still show that they were offered coverage, and yeah, and yes, you have someone else asked, do we have to report if they took COBRA? Yes, you report if they took COBRA. If you have an outside company handling COBRA, so you don't know if an employee accepts coverage or not for 3 months, that's probably something that you need to change with your COBRA administrator. That they will need to let you know that, and they'll need to let you know before the end of the year. And maybe talk with me afterwards about some of these really specific COBRA questions. But if they waive coverage because they have coverage through another, you're still going to show that you offered coverage, whatever the coverage was that was offered, and then let me see if I can find the right slide to show this. 12. Oops. For example, if the person had the rate of pay, say, that was offered coverage, and it was based on the rate of pay safe harbor, so it was $120. If you're still offering it at $120, but they don't elect it, then you could put in 2H, for example, that it was offered under the affordability rate of pay safe harbor applies. Or if it's not subsidized COBRA and the rate of pay safe harbor doesn't apply, or the W-2 safe harbor doesn't apply, then you would just leave it blank. So let's see. But if you offered the coverage, let me get back to that question. You're still showing that you offered it, and so if you might end up leaving it blank. If the offer of coverage that was made was a qualifying offer, then you would have 1A in line 14, and you would have nothing in line 15 or 16. If the offer of coverage was 1B through E, you would put in the appropriate code. For example, if it's a rate of pay and it's offered to employee and spouse and dependent, and then in line 15 you would put in what the dollar amount was. And again, if it's a rate of pay, you'd put in 2H in line 16, that it's an unaccepted offer with the rate of pay safe harbor, or 2G, unaccepted offer with the federal poverty guideline safe harbor, or 2F, unaccepted offer with the W-2 safe harbor. So let me see what other questions. Oops, I think I'm going the wrong direction. Waive coverage, held source. COBRA. Someone asked, did the instructions change for COBRA from page 10? Yes, they sort of did change. In the IRS page that lists questions and answers on completing the forms, the question and answer 17 addresses the COBRA issue, and it partly changes depending on whether the employee enrolls in COBRA or doesn't enroll in COBRA. So even if they're terminated, and then if they enroll in COBRA, you would indicate in each month, like in line 14, rather than 1H, the coverage that was offered, which is probably going to be 1E for a COBRA participant. But it depends on whether they enrolled only for themselves or also for their spouses or also only dependents. And then if they don't enroll anyone, then it would be 1H, and they would be the code in line 16 would be that 2B, that they're not a full-time employee, or that they're no longer an employee. what if COBRA is not elected but employee elects for family members only? Then, let me just see how many more questions I've got here. Okay, it looks like I have quite a few more questions. So it looks like we still have 48 people left on the call. So I'll try to go through these questions if you guys want to hang in there. If the employee doesn't elect COBRA but does elect it for a family member only, then you would which one is the closest? Then you would be doing a 1094. You wouldn't have to offer anything if you're insured, and the carrier would be filling out the 1094B, showing that they for the family members. Or if you're self-insured, you would put the information in Section 3 on individuals who are enrolled in the plan, but it wouldn't have to be in Section 2. But you would file this information for the employee. But the employee who elects not to take COBRA, example 9, if the employee terminates and does not elect COBRA, you would have 2A in the rest of these boxes for the rest of this year, indicating the person is no longer an employee. But you would, and then again, for the covered family members, you would, if you're self-insured, include the information in Section 3. And if you're insured, then the carrier would include that information on the 1095B that the carrier sends to the family members. The next question is, what if someone is hired on the 6th of the month and they enroll in coverage and they are covered for the whole month? I'm not sure if that means they're covered retroactively to the 1st of the month, or if you're saying they're enrolled for coverage for the rest of the month starting on the 6th. So the code for line 14 is 1H if coverage wasn't offered for every day of the month. So, and the 1A, 1B, 1C, 1D, 1E code are for coverage had to have been offered for every day of the month. So it's probably going to be 1H, and probably that first code in line 16 would be that they're in their limited non-assessment period because they were for part of the time. So I don't know whether to tell you that would be 2C, employee enrolled in coverage offered, but that's basically if they enrolled for every day of the month. And I don't know that you could have them enrolled for every day when they weren't your employee before the 6th of the month. On that, one thing I would say is check with your payroll provider and see how they're coding that, or if you have an outside service. What about an employee who terminates in March, but severance is offered to the employee to keep coverage in force through October? He isn't an employee, but we still have coverage and no cost. So I'm not sure what the answer to that is, and I don't think the IRS has addressed it. But I think what you'd have is, if he terminates in March, if it's 1A, if he was offered a qualifying offer, you're still going to continue that through October, but 2A is no longer an employee, so you're going to have 2A in line 16 for the months that he's no longer an employee. But I can't guarantee that's what it is. That's a good question, and maybe that's something that the IRS will address. The next question is, what series code 2 code would we use if the employee waives coverage? Would it be 1E2F if we use a W2 safe harbor? So if the employee waives coverage, And if what you offer is 1E, the MEC provided to employee and dependents and spouse, but use the W-2 safe harbor. So line 14 would be 1E, and yes, 2F would be unaccepted offer with W-2 safe harbor. So yes, that's what it would be. And you probably need to put in the dollar amount in line 15. Let me see what the next question is. What codes would be used for a seasonal employee who works full-time for 5 or 6 months during the year and then is laid off? So I'm guessing with the seasonal employee that the seasonal employee is also in their limited non-assessment period during the 5 or 6 months of the year that they're employed. So you probably have 1H would be no offer of coverage. Let me see if I have one that's closer to that. You probably have 1H is no offer of coverage, and then 2D would be, it's probably something like this, and then 2D would be limited non-assessment period. But instead of this kind of example, it would be 2D for the particular month the employee was there, and then once they were no longer employed, it would be 2A, employee not employed during any day of the applicable calendar month, and line 14 would be 1H, that no coverage was offered. So it's probably more like the part your Paul, except if no coverage was offered, you'd have 1H for line 14 all the way, and line 15 would be blank, and line 16 would be 2D, and then it would be 2A. So, but again, this is probably something you want to have your payroll system handling rather than you having to do all this for each one. The next question is it an issue if line 15 has a premium amount for all months if we only have one plan, same cost for all employees? Is it critical to remove that rate in all months where the coverage was not offered or not eligible? I think, well, the instructions say that that amount shouldn't be there for the months where coverage was not offered. So I don't know what will happen in the IRS system if you have the dollar amount in those months, but the instructions do say that you shouldn't have it in those months. Like if line 14 is 1H, then you should not have an amount in line 15. So I suppose that what's likely to happen is that the system is going to kick it out and say it's incorrect. So you probably don't want to do that because you need to show that you made reasonable efforts to put in the correct information, and my guess is that might be an issue because the instructions say that if it's, for example, if line 14 is 1H, that line 15 should be blank. So if all you had to do was not have information in there and you put it in, I'm guessing because it's just run through a, it's all electronically determined, that might be something that just kicks your return out as incomplete or inaccurate. And you could end up with a penalty for that, the $250 a day. I mean, $250 per return, not per day, unless you show that you made reasonable efforts to comply. And that might be a little hard to show if all you needed to do was not have the dollar amount for those months. So let me see. I think that's it. I think that's my last question. Let's look what codes we use for seasonal employee. Oh, here we go. A few more questions. Sorry, it looks like I've gotten a few more in. What? employee premium, is it critical to remove? Does a qualifying offer of affordable health care have to be made to employees and dependents or just to employees? If it's a qualifying offer, it has to be made to employee and dependents. What if an employee declines the offer? What codes do you use? Probably you put it, you leave it blank. If you offer the coverage but the employee declines it and they're still your employee, then you're probably leaving it blank. Or if what the employee declined, or you'd use the codes 2F, 2G, or 2H. So if you offered coverage that met the W-2 safe harbor for all months of the calendar year, then you would put 2F, which would be in line 16, unaccepted offer with W-2 safe harbor. If you offered coverage that met the Federal Poverty Guidelines safe harbor, and you offered that, and the employee did not accept it, then in line 16 you would put 2G, unaccepted offer with Federal Poverty Guidelines safe harbor. And if it was a rate of pay safe harbor, then you would put 2H for every month that you offered it, but the employee declined the offer. Yes, retroactive. So I think that's it. And contact me or your Leavitt advisor if you have additional questions. Thank you, everyone, for hanging in there. And if you do want a copy of the PowerPoint and you don't have one or any of the handouts, again, contact your Leavitt advisor and we'll get you a copy. And again, I hope you all have an outside payroll or provider service that's handling this for you and that you're